Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Before we start the show today, I'd just like to take a moment to remember those who've fallen. This is Memorial Day weekend, folks. Please remember those who gave all for our freedoms. It's not about shopping. It's not about sales. It's about this. It's about this and coffins and people that never made it home so that we could have the freedoms that we enjoy. So just pause and think about that for a minute. I don't want to get too deep, but I just wanted to say that. Now, to the markets look like they're poised to rally and rally strong. Now, we could be wrong. Price is truth, always. We always follow our rules regardless. But why do I say that? Well, first, U.S. and the Iran deal looks very promising, and it looks like the Straits of Hormuz are going to open real soon, and oil is coming down. And that's going to be bullish for the market. Second, Kevin Warsh was just confirmed by the Senate as a new Fed chair in a 54-45 vote, taking over from Jerome Powell. And he already officially assumed leadership on May 15th. He plans to fundamentally reshape how the Fed operates, particularly measuring and controlling inflation. So what he's doing, the Fed has always used the PCE, the core PCE, the personal consumption expenditures, which can get one or two outliers can make the whole thing spike, or it just has wild moves. And he wants to take a median or a mean metric. And actually what he wants to do, he's saying PCE is a rough estimate. And he actually wants to replace it by surveying billions of prices using the BLS, Bureau of Labor Statistics, and private sector data. And with AI, that makes it much more possible. I'm not saying he's right. I'm saying that's what he's going to do. Or he's going to try to influence all the other Fed members, because there's other voting members, to do that. Now, here's the kicker. Here's the takeaway that some are missing. He's also committed to substantially shrinking the Fed's balance sheet, arguing that a smaller balance sheet reduces market distortions, which they do, QE and all that other stuff, and allows the Fed to better handle future crises. Because if it's too big now, they can't take on too much more debt. What do we want to do? Be like Japan, where Japan, the Bank of Japan owes 90% of all their debt? It's a fake bond market. Now, what does that mean for bond prices, private bond prices? So when they have a big balance sheet, they're basically buying bonds and pushing pushing interest rates down. Well, if they start shrinking their balance sheet, letting them either bleed off naturally or even selling, which I don't think they'll do, but selling treasuries, that's going to put prices, make interest rates go higher. So it's kind of a yin and a yang. He can set the short-term rate. It's actually not called the Fed funds rate. That's the overnight banking rate. It's called a discount rate. And by declaration, he says, I want to drop the discount rate by 0.5%. The CNBC gets it wrong. They always call it the Fed funds rate, because then all the banks who are in the Fed system, they follow suit. Because if you don't do what the Fed says, you get slapped around. So he will try to drop interest rates by declaration. That's short-term rates, not long-term rates. But what happens if he starts shrinking the balance sheet as well? Those are kind of a little bit opposing each other. So it's going to be real interesting to see. But in my personal economic hat, put my economic hat on, I think it's going to be very interesting. And I think even though people think he's going to lower rates by declaration, short-term rates, and they may come down temporarily. But if he shrinks the balance sheet, that's going to do just the opposite, in my opinion. But who knows? We'll see. Remember, price is truth, no exceptions, period. All right, with that, I'm going to turn it over to Don and the team, but Don's got a technical mailbag that was posted on YouTube by this active a female trader, and he'll get into that. He's going to explain that, right? And he's also going to toot our own horn about some YouTube growth we've been having, folks. Just go to YouTube and type in Revere Asset and hit subscribe. And Zach, our producer, will have this show out by, normally 1 o'clock Central Time. If you can sign up on our website too, but if you do that, it comes Saturday morning. So there's 2 ways to get our content. And with that, Don, what's happening, and what did this woman say?
Well, let's start off with a couple of weeks ago, I started, and really over a month ago, we started pushing harder for likes to increase the number of likes that we're getting. It's kind of pathetic that only approximately 10% of the people that watch our videos click the like button, despite all of the kudos that we get for all the content that's out there. So about a month ago, a little over a month ago, started pushing harder. We set a goal by the end of this quarter. We wanted to increase our average nightly views from 800 up to 1,000 and increase our likes from 10% to 20%. So our baseline is really 1,000 views and 200 likes. And I'm really happy to say the viewers have really responded. We've blown through 1,000, getting closer to 1,100 on the last 5 releases that we did for video. Likes getting closer to the 200 range, but very often in the low 100s. And we'd really appreciate everybody out there. I know some people don't want to have a Gmail account, and you can't like and you can't comment if you don't have a Gmail or a YouTube account. Create one. You won't get spammed. You can use it only for trading. That's one of the benefits of you being able to control your own personal social media and your email accounts. But so we very clearly met that goal, and a lot of it has to do with the shorts that we're putting out. A summary of the prior night's video and the weekend videos and the podcast, 3 minutes. We got a guy over in England who does a fantastic job because he understands the markets of picking out all of the key segments and puts it together, and that has been a huge contributor to our success. So his name's Dan. Just another great guy named Dan, I guess, huh, Dan?
That's a great. I know. It's biblical, Don. Daniel.
More confusion because I get called Dan as often as I get called Don. I don't know if you get Don a lot, but I get Dan a lot.
Yeah,
but anyway,
people get we should have. Yeah, we didn't think it through because now with all the big growth, the first names are not quite enough. But but we keep them out of the fire, like Daniel in the lion's den. We keep them out of from getting eaten alive by the market.
Oh man, what a great segue there, Dan.
You're welcome.
All right. So what I'm going to talk about last night in Connor's video, one of our fantastic followers made a comment. She said, "Hi, Connor. Very great info as always. Do you try to keep your balance at risk within a certain percentage of open profits? In other words, if you have a balance of risk at 5.45%, I assume your open profits are at least 5.45% or greater. How high do you let your bar, that's balance at risk, get in reference to what is open?" Great question. Balance at risk is our REBAR, Revere Estimated Balance at Risk, which was featured on an investors.com article from Ted and Connor's interview with Justin Nielsen on the IBD podcast. So now the world knows what one of the things that Revere does, and it's part of our secret sauce. And it's what our drawdown would be if all of our stops were met over the course of a day or two, or one day, or a month, or whatever. So Connor's reply was, yes, exactly. We monitor this closely and call it the floor, which means what has the portfolio made versus open risk. And we want to see this climb higher to ensure progress is being made and keep the equity curve smooth. Great answer, Connor. And then a follow-up question. So no specific measurement, but closely monitoring based on progress. And that's accurate. Also, what is the best video to watch to capture Revere's overall management? I so appreciate how much you guys share info. It was helped in my position sizing as I've built the RVF. That's our Revere Volatility Factor. That's a score that we give every ticker, and it's 75% beta, 25% average true range. We give a stock a score. The higher that is, the lesser of a position size we want to take, because we want to smooth risk across all of the holdings. So she said, as I've built the RVF and other ideas like SPY to catch rotation and smoothing the equity curve, this is a trader that absolutely gets it. And that SPY, that's why we keep half of the portfolio in index ETFs, including leveraged ETFs. We actually don't use SPY. We use SPY-M, because SPY holds your dividend for over a month, 4 times a year, which is ridiculous. SPY-M, IVV, and VU pay it out within a couple of days at the end of the quarter. I plan to give my portfolio to you guys if I ever can't manage it myself, and my husband has explicit instructions to contact Revere if anything should happen to me. That's about a dozen people now that we've heard that their spouse has explicit instructions to contact Revere if they're the primary portfolio manager for their household, and if anything ever happens to them, they have instructions to call Revere. And that is about the best testimonial that we can get from anybody that we don't manage their money for. So thank you very much for this fantastic testament. And as far as overall video, we have plans to do something at some point in the future. Don't know exactly when or how we're going to do it, but it would be like a Revere from A to Z, starting with onboarding, going through assimilation, and then our portfolio management process. We're going to document some things, put them together, and release that. So again, thanks to everybody out there. And hey, like, share, and subscribe. We're also on Spotify now and on Apple Music. So you can stream our podcasts and videos that way as well.
I think even maybe Google Play. Can I put my Don Interpreter hat on real quick?
Please do.
Okay. So when he's talking about the RVF, the Revere Volatility Factor, what he's talking about is it's 25% beta, 75% ATR, average true range.
Opposite.
I'm sorry. Yeah.
75% beta.
Right. 75% beta, 25% ATR, the average true range. So if a stock moves 3% a day and you have your stop, and we don't use hard stops because the market makers know where they are and they rape retail investors all the time and steal them away. But we've got alert sets. So when I say stop, we're not really truly using a hard stop, but that's our sell level, right? But if a stock average true range is 3% a day and you have a 6% stop loss 2 down days in a row and you get stopped out. So the more volatile the stock, the lower you need to give it more room, and you need to have a lower stop loss, right? That means you trim its position size, and then alternatively, a stock that's less volatile, 1.5 ATR and less of a beta, you can have a closer to the market stop, and you can have a larger position size. So what he's doing is, it's almost like, racing, horse race. I always use this example because my wife loves horse racing. You're handicapping the stocks, I almost said horses, out of the gate, right? Because we don't know which one is going to get stopped out and not work out. If I knew that, I'd own Maui and we wouldn't be having this discussion, right? So now you say you buy 10 stocks, they're all have their own unique stop loss. And then once they go, a few will get stopped out, a few will go up, and then start to roll over, and they get sold for, modest gains or some gains. And then 2 or 3 or 4 will just run. And we keep feeding those. And we average up. You don't want to average down. If you've got an advisor saying, oh, the stock's down 10, 20%, we need to buy more, you need to ask them, why did you let it drop 20% in the first place? Okay? You don't average down. You actually add in to the stocks that are working. That's an IBD Bill O'Neill principle. But this way, now you have a control of the portfolio. In fact, we have Don, Don uses all these, what do you call them, the words like RVF.
Acronyms.
Acronyms, there you go. Thank you, Don. Don's the grammar king. That has the whole portfolio balance at risk, so that if you really had a bad day or really the market starts to blow up, how much would, if we got stopped out on everything, which happens extremely rarely when you go to 100% cash or even maybe slightly net short, what is our downside? So we know our downside on every single stock and the portfolio as a whole. Ask your advisor if he's doing that. Okay, Don, was that pretty good, or did I chop that up?
That was good. So the RVF is the score for an individual stock. You add up all of the RVF totals for the portfolio, multiply it by the position size, and that gives you your RVAB, Revere Volatility Adjusted Beta. That tells you how much exposure you have, how much risk you have for your overall portfolio. You mentioned some stocks just don't work, Dan. I've got Starbucks up here. This is one that I bought. I've been tracking this story closely because they've got the N factor. They've got a fantastic new CEO, came from Taco Bell, turned around Chipotle, and has a plan in place to turn around Starbucks. They surprised on their last earnings report. It really got on my radar. Did 2 buys on it. You can see it consistently made higher highs and higher lows, which is exactly what we wanted. But while that was happening, the relative strength was waning. And yesterday it broke below actually today it broke below the prior low. So now it's making lower lows and has pierced the 21-day moving average today. We sold half of this morning on that break. We'll see what happens to the other half by the close, but they don't all work out. And here's one that just doesn't work out. Really, the market is being dominated by the AI data center related names, plain and simple. We like to keep some diversification in our portfolio for high upside non-tech names, because that's part of the process. William O'Neill says that's how you get your diversification, but whether we like it or not, it's few and far between a non-tech stock that is making huge moves, non-AI related stock, but we're always looking for everything. So that's a perfect example of something that doesn't fail. And that's one of the reasons why we get the cred that we get on the street, because we talk about what doesn't work. We don't toot our own horn
warts
and act
all,
like everything.
Warts and all, yep.
No, yeah. You know, I say the good, the bad, and the ugly, but we really don't have any ugly. We've eliminated ugly from the possibility of our holdings because we're all accountable to our clients and to each other as portfolio managers. It's just part of the process. We don't take big losses. We had an account come in today, almost $1 million with 22 tickers. When I look at the history, I see things that they got stopped out on for 30, 40, 50% losses. That's absolutely outrageous. And any portfolio manager that is holding something, especially when you've only got 20 holdings and it's going down 30, 40, 50%, they deserve to be fired. So we're very happy to welcome that account into Revere, and it's a referral. In this case, it's a son referring his mother. We started talking about interest rates, Dan, and something that is extremely important to keep an eye on is the 10 and 30-year treasuries.
Yep.
What we saw 3 days down in the market earlier, starting on Friday and earlier this week. Those 3 days down in the market coincided with 3 strong days up in the 10 and 30-year yield. Those rising yields are bad for the market. What did we see the last 3 days? We saw rates come off on Wednesday, hold steady on Thursday, make a lower low today, but they're at their high of the day right now. And we are keeping a close eye on rates because they seem to have control of what's going on with the overall stock market, that and the Iran situation. So even if the Iran situation gets resolved, there's no guarantee that the market's going to get higher if interest rates keep going higher. So we've got on our main screens a very close eye on the 10-year and the 30-year yield tickers to track this. If you actually wanted to play it, we had this on our watch list but didn't pull the trigger. TBT is a 2 times, TMV is a 3 times, and you can see these ETFs moving exactly in sync with the interest rate. It's frankly a good hedge for the portfolio if we were looking for that, but we are in a bull market. We want to take advantage of the stocks going higher. So what do we got today? Let me go back to the S&P 500. And you can see that breakout to all-time highs, close over 7,500 last Thursday. Pullback started on Friday with the breakout in rates, Monday, Tuesday, Wednesday. Rates pulled back. The S&P and growth stocks got back into gear. Same thing with Thursday. And now we hit 7,500 as a high out of the gate today. And we've pulled back a little bit as rates started lower and have rallied intraday. So you're really seeing a direct opposite correlation in what's going on with the longer term interest rates and the overall market. So we've got a very close eye on that. Keep raising, back to the mailbag. We keep raising our stops. That raises the floor. So each day as we make progress in the portfolio, the floor, or which is our balance at risk minus it's the gains that we've made since we re-engaged with the follow-through day minus the balance at risk equals your floor. And when we start out from zero and get engaged in the market, we usually give ourselves about a 2% downside as we start putting positions on. And then so your floor starts at minus 2%, and then your floor keeps rising as your progress in the portfolio rises. So if we have 10% gains and our balance at risk is 5%, that means we're going to lock in at least 5% of those 10% gains when the market pulls back. If the market pulls back, market keeps going higher, we keep raising our floor. The balance at risk kind of stays steady, fluctuates a little bit, but that's because we're taking offensive profits. We're getting stopped on some new ideas, and we're putting on new positions. So the balance at risk changes every day depending on the activity of the market and the activity of our trades. But the point is to keep raising the floor. The ceiling is the maximum gains that you made since we re-engaged. The floor is your gains minus your balance at risk equals your floor. So very good question that was asked in the mailbag, and I think hopefully I've answered it. Dan, if you think you need to clarify anything on that, by all means, go ahead.
No, that was pretty good, pretty technical. I just want to ask again, does your advisor sound like that? One last question: hopefully you're watching this on a computer, or so you can see the charts too. You can hear this on podcast streaming, but it's better on the computer because then you can actually see what he's looking at. But if you look at that strong uptrend just recently, we had a few clients scared about 3 weeks ago, wanting to really move to cash or pull the plug and say, I'm scared. And I said, the market's starting to rally strong. Price is truth, no exceptions. You got to check your emotions at the door. Emotions don't work. CNBC doesn't work. Well, I was going to say something about Kramer, but I won't. Anyway, the best thing you could do is put CNBC on mute. And most of those guys that come on, except the huge hedge funds and Buffett or whatever, it's pay to play. Those guys paid $3-4 grand for a 3 or 4 minute hit to sound good. And then they can put it on their website and say they're a CNBC contributor. Did you know that? One last thing. So you want to make sure that you've got rules in place, and 95% of all the advisors out there are pie charts or us. They're farming out, buying funds, or doing an ETF, and maybe they'll do some kind of monthly rotation, or they'll do some rebalancing on some arbitrary date. We're actively managing this daily, not monthly, not quarterly, not semi-annually, and certainly not annually. All right, Don, take it away.
All right, so that's where we are on the S&P. Let's quickly go through some of the other indexes and the Qs. What is going? Okay, there we go. A little slow, but you can see the Qs very much in sync with the S&P, challenging all-time highs today. RSP equal weighted. This has been lagging on a relative basis, but you can see it broke out today above this nice cup and handle. And although the relative strength has made a turn up over the last week, this has been lagging relative to the S&P 500. But good news there to see that. IWM, small caps, 3 hard down days, broke below the 21-day moving average, reclaimed the 21 on Wednesday, higher high on Thursday, higher high on Friday. Again, moving completely opposite of what interest rates are doing. So that is the view from the sky. Let's get the usually fantastic and often outstanding segments from our staff. And we're going to start with Connor today, and he's going to talk about semiconductors, but a niche within semiconductors, 3 names that we don't talk about very often, but 3 names that should be on your watch list. Take it away, Connor.
Yep. So, right, you look at the broad semiconductor group, and there's so many different names flying left and right. And I wanted to talk about a certain niche group in this overarching sector, and that is power semiconductors. And I'm not going to go into super in depth, but basically, what these names I'm going to show is that the AI power build out needs specialized chips to handle the massive electricity demand. And the 3 stocks that I'm going to talk about today are 3 the pure play for this. So STM is the first name. And when you look at the daily chart, it is definitely short-term extended. But if you go to the monthly chart, you can see how big of a base that this has. And we've seen these green line breakouts work extremely well in this market environment. And, this one has a huge longer term base. And on the daily, it's been shown a lot of RS, extended short term, but this, is the type of name that you would look to buy on a pullback, whether that be to the 8 or the 21 EMA. And one thing I want to add with this name specifically that I find very interesting is STM, they design and manufacture semiconductors utilized in the SpaceX Starlink satellites. And as we know, SpaceX is going to IPO this year. There's a lot of hype around that. And STM, they design and manufacture semiconductors utilized there. Next one is ON. This is another one that, fits the power semi theme. And on this chart, pull up ON, Don. And you can see this one is acting great. This one isn't as extended as STM. And you can just see it had a really nice move out of that, early base around 72, 73 area. It triggered ants, which is typically a bullish sign, especially when a stock is beginning its move. And then today it's putting in a nice upside reversal here back above the 8 and 21 EMA. And this one's got a nice little flag break. And then lastly, NVTS. This is a smaller one, a little bit more high beta. And if we start with the monthly chart on this one, daily, it is again a little short-term extended, but this one is just now getting into price discovery mode. As you can see, the volume is really ramping up on this one. Trades almost $500 million in daily dollar volume, and it's been one of the strongest semiconductors in the market, and it's falling through again today. Again, short-term extended, But the theme here with these power semiconductors, they're definitely leading the overall theme. And these are three of the pure play ones that we like, that we're watching. And, we'll see how they act in the coming weeks. But short segment, but, three semiconductors to watch out for.
Great stuff, Connor. And something that's very important to point out, some people don't pay any attention to the story behind the chart. And William O'Neill, one of his most famous quotes is, "It's not the chart, it's the story behind the chart." Because in a bull market, there were hundreds of stocks that were setting up in flat bases like this, showing minor relative strength. But how do you distinguish between the ones like this that are going to shoot to the upside and the ones that are just going to break out and meander, kind of the way Starbucks did? And it's that N and the theme. And plain and simple, that's why O'Neill studied the fundamentals so intensely and combined the technicals with the fundamentals for the buy. Now, for the sell, you don't go by the fundamentals because the market is looking 6 months ahead. You go only on the technicals when you sell. And that's why we're going to stop out on Starbucks, because as good as the story is, it's not holding the 21-day moving average. It means it's not a leader and the relative strength line is lagging. So we'll cut it from the portfolio and go with, it's a great setup. Fantastic. STM and the other ones that Connor showed blasted off to the upside. Starbucks languished, going sideways. That means it's not a laggard, or it's not a leader, had potential to be a leader, made higher highs for 3 weeks, but came apart the last couple of days. So the market is not interested in it. Therefore, we're not interested in it.
Right.
Excellent stuff, Connor. So let's go to Ted and another extremely leading theme in the market, DRAM, these memory chips. And again, it's the story behind the base. And you can see what this is a very well-timed release of an ETF by Roundhill. Take it away, Ted.
Thank you, Don. Another famous William O'Neill quote is that what seems high tends to go higher, and then what seems too low or cheap tends to go lower. This is likely an example of what seems too high tends to go higher. I mean, we've been trading SNDK and MU for the last year, and since we swing it, we don't hold through 20-30% drawdowns. We've continued just to see these names head higher and higher and higher. They beat on earnings and revenues in a big way, and they continue to be a bottleneck in the AI build out. So this is DRAM. It's an ETF comprised of SNDK, all the memory names, and I believe also SK Hynix and Samsung. So it does bring some Korean memory exposure as well. And this came public early April, and it's made this huge 100% plus move. Pulled back, undercut, and reclaimed the 8 EMA. Pretty much held the 21 as well, and now it's starting to form a flag here. So this is pretty much a textbook William O'Neill high type flag that is forming inside day today, and just really looks great. Strong, some of the best relative strength and liquidity in the markets. The first name is SNDK. Also broke out of this big base coming out of the correction, trended against the 8 EMA perfectly. Finally cracked the 8, but there's no problem because it held the 21 and reclaimed the 8 quickly. And again, just like DRAM, it's putting an inside day here right at the 1500 hold the number. And this is also setting up really a textbook high type flag here. You can look at the earnings numbers. It's really just off the charts. Does that say 7,000% year over year? I can't fully read it on my end. And then revenue growth is 251% year over year. So incredible growth, continued huge demand for memory in this AI build out overall. And I'll just quickly go through the other charts because they're quite similar. Next one is MU. This is owned in Turbo, and we're still just trailing the 21 EMA. Also undercut and reclaim the 8 EMA. This is 4 days up in a row. A little different look than DRAM and SNDK, with DRAM and SNDK having an inside day and flagging out a little better. So I potentially see this maybe see some sort of downward drift over the next week, maybe 2 weeks. There potentially be another add-on opportunity here as well. And you can see the earnings and sales, triple digits on earnings and sales as well. And then next one, WDC. We consider SNDK, MU the leaders, although WDC and STX, which is the last name, aren't doing so bad themselves either. You can see broke out of the base, trailed the 8 EMA, rode the 8 EMA perfectly. And all these charts have similar price action, which just tells you institutions are accumulating this group as a whole. You have a similar chart theme where they break out of a multi-month base, ride the 8 EMA all the way up, get a little bit extended, hold back to the 21, holds the 21, now reclaiming and flagging as well. And then the final one, and also this also has triple-digit earnings and high double-digit revenue growth as well. And then the final one is STX. Again, you can see the chart theme and the group theme as well. Broke out of a multi-month base, rode the 8 EMA all the way up, got a little bit extended, broke the 8, pulled back to the 21, and now we just reclaimed the 8 again. This is also flagging out. I would say maybe another week, and they potentially put in perfect textbook high tight flags. William Mill described that as 100% plus move up with it in less than 8 weeks, pull back no more than 20-25%, and then 12 to 15 days of sideways is typically the perfect range for high tight flag. Over 15, it starts to become more like a Darvis box or a flat base, 4 or 5 week flat base. So this 12 to 15 range area for consolidation is perfect. And you can just see there's support that came in a big way. And we'll see how these names shape up in the next week or so.
Excellent, Ted. So we've got a theme that has been going for a while, and Connor talked about the new theme on those power semi chips. And let's take it over to another emerging theme, again AI related, but from an unlikely or less likely sector. Todd Zilla is going to talk about 2 solar stocks with new ends. Take it away, Todd.
All right. And interestingly, both of these companies use power semiconductors in their key technologies. SolarEdge and ENPH are the 2 stocks I'm going to be talking about. And we go to a weekly chart on SolarEdge. These peaked back in 2022, and they failed miserably after that. And they've really kind of struggled through a transition where the administration basically eliminated the subsidies for solar systems, as well as higher interest rates, which most of these solar installations are on rooftops at the home level. And it requires financing. They're expensive. And rising interest rates have been a headwind. Subsidies have been a headwind. But now we have somewhat of a new factor going on. Both of these companies are solar inverter companies. Solar inverters they convert DC power to AC power. Solar panels create direct DC current, and we use AC in our homes. So each of these companies are well versed at converting that power. This conversion is the same thing transformers do. Okay, we have a shortage of transformers going on where traditionally these transformers are made of copper iron and they're utility grade. The data centers require more sophisticated power conversion, and these companies are used to doing that at the solar level. So right now, the big buzzword with both of these companies is solid state transformers. And both of these companies are in the developmental space of the semiconductor power-based transformers, which are going to start being used in pilot programs later this year, and they're going to commercial production by 2028. And by 2030, we're talking about potentially multi-billion TAM for these companies. So that's what's recently moving these companies. And they're not yet earning any revenues from these solid state transformers yet. But Goldman Sachs came out yesterday and on ENPH basically said they're at a big inflection point. And, both of these companies are really the key leaders in this new solid solid state transformer business. So anyhow, let's get to the chart. That's enough of the fundamentals. I do like the fundamentals, and that helps me, follow the story. You can see Solar Edge just broke out here of a base on base pattern, pretty powerful last week. Came back in, touched the 8-day moving average, and took off again. Connor was right on this. Bought that pullback to the 8-day moving average. Beautiful entry. I joined him on it, and these have had some nice follow through action. Looking at Enphase. They just announced a new major product using gallium nitride, which is also, both of these companies are using high-tech materials. Solar Edge uses silicon carbide, and Enphase is using gallium nitrate, which both have some advantages. Overall, this company is now entering the commercial market for the first time with their new gallium nitrate products, inverters. This has taken off, broken out solidly out of this big cup base, pretty deep, 44%, but nonetheless, very powerful breakout. And, again, both of these companies are being re-rated with the data center theme, even though they're still maybe a year or two off of full production. They're seeing billions in potential new business coming forward with both these companies. So that's what's driving this solar change right now.
Fantastic stuff, Todd. And again, it's not the chart, it's the story behind the chart. Dan, that is everything from the tech side today, and you can bring us on home.
I wanted to make one comment before I close the show, because Ted brought up a point about the story, but also the low PE stocks versus high PE stocks. Bill O'Neill used to say, you want to buy high and sell higher. You always heard from Wall Street, you want to buy low and sell high. Folks, PEs are earned. So a low PE means that stock is struggling. It's a dog, and it may take 2 or 3 years for the market recognizes any value, if there really is any value left, because not all stocks make it, right? And so if a stock has a PE, Don put up a few stocks up there that had PEs of 60 or 70, or just call it 50, make it even to make it. That sounds high, but if they have a 100% growth rate, that means their PE next year is going to be 25. All things stay the same. And the next year is going to be 12.5. That's why the growth rate, the story, and the growth rate are so important. Those are the stocks that are going to make the most money. And as long as you have stops in place for the ones that don't work, because they are more volatile than Procter & Gamble or something that's got a little dividend. Everybody loves dividends, right? If you got a 4% dividend and the stock goes down 25%, did you make money? No. You paid tax on the dividend and you're still down 21%. So think about it, folks. One last thing. Does your advisor sound like these guys, or do they just want to ask you to go to lunch? Listen, if you like what you heard, please tell a friend, tell a neighbor, just send them to revereasset.com. Up in the right-hand corner, there's a subscribe button. And this podcast will go out Saturday morning. And every day the market is open, we do a short market. It's like drinking out of a fire hose, market summary of the overall indexes, and then the stocks we're following, and what we actually did in our own portfolios for clients and us, Don and myself. We have the same timestamp and price as our clients, okay? We're the most transparent advisor that I'm aware of in the United States, if not the world. We're putting out content every day the market's open. Now, if you go to YouTube and just hit subscribe. By the way, on the website, there's also next to subscribe, there's a contact us button. You can hit that contact us and ask us about a stock, or if you want a complimentary portfolio review, or you want to become a client or find out our performance record. All right? Lastly, if you go to YouTube and just search for Revere Asset and hit subscribe, you'll have this podcast. We do it Friday morning before the market even closes. That's how most of our stock nerds do it. And you can always call us at Old School at 855 Real Wealth. Folks, remember Memorial Day. Have a great weekend.
Because it's not how much you make in the market, how much you can keep.